Good afternoon, everyone, and thank you for joining us. My name is Vito Dintrono. I'm Yarra Capital Management's Chief Commercial Officer, and it's my pleasure to welcome you to this webinar with Dion Hershan, our Head of Australian Equities, and Ed Waller, our Senior Investment Manager in the Australian Equities team. Importantly, this is the second of a series of weekly updates from the team, and it forms an integral part of us, providing you and continuing to commit to provide you with access to our people and our key insights. So very shortly, you're going to hear from Dion and Ed, who are going to take us through an update on Yarra Capital's current observations on the COVID-19 pandemic, focus particularly on how it relates to Australian companies and how that's informing our views with, and ultimately which companies we are choosing to own through this environment. But before I get started, just a couple of housekeeping matters that we should deal with. So first is that you'll be listening to this update, most likely using your computer speaker system by default. But if you prefer to join over the phone, just select your telephone in the audio pane and the dial-in information will be displayed. All participants are in listen-only mode, but you'll all have the opportunity to submit questions by typing your questions into the question pane of the control panel. Just look for the question mark symbol. Importantly, you can send these questions at any time during the discussion, and we'll look to address as many as we can during the Q&A session post today's presentations. Quickly, the structure of today's session will be first you'll hear from Dion for roughly 10 minutes or so, then Ed for another 10 minutes, and we'll spend the remaining allocated time on Q&A before wrapping up a little after 3:30. So with that as a backdrop, I'd like to hand over to Dion Hershan to kick things off.
Thanks, Vito, and I want to welcome and thank everybody for their time and their involvement today in what is obviously some pretty challenging circumstances. It's simply extraordinary when you reflect upon where we are today and how fast things have changed over the last 3 months. 3 months ago, the top issues of discussion were trade wars, climate change, and AFL premiership predictions. In fact, I think that's a salient reminder that we should actually be challenging what seems obvious and consensus at this point in time, because it's likely to be vastly different in 3 months' time. On today's call, I want to do a few things before I hand over to Ed. Firstly, I want to frame how we are seeing the environment. I want to put a spotlight on what we think are some of the central issues from a research perspective, and I'll build upon the work that the team has done. The team's been in overdrive over the last month, doing probably north of 20 company meetings a day, and share some of the observations that have been put forward. We also want to put a spotlight on a few opportunities that we think are compelling at this point in time, and we'll call that infrastructure and energy. We might also boldly, or you might say stupidly, make a few predictions about how we see the environment in the future and how we're setting up our portfolios. The slides you've been provided with are really there for a reference only. I won't be talking directly to those slides, but we'd welcome any questions that might arise from them. The first thing I want to call out, at the risk of stating the obvious, is COVID-19 is a health and an economic shock like we have simply never seen before. What is obvious is this is not a traditional business cycle. Recessions, albeit infrequent in Australia, are a pretty well-worn path globally. We are typically debating the slope of the slowdown. COVID-19 was literally a hard stop. The multiplier on the actions that have been taken have been massive. And as close as anyone can recall, this is pretty much a synchronized shutdown of major economies around the world. And the size of the shock and the speed with which it occurred really has put companies, and this is the companies we invest in and others globally, into what we describe as self-preservation mode. And as a consequence of that, we saw employment implode, we saw activity implode, and we're probably tracking towards almost depression-style levels of business activity. But with that as a backdrop, what you would have expected has occurred, which is governments globally and central banks have intervened. And as much as possible, they've tried to backstop the economies with what I described programs that would be simply so much larger than we could have anticipated, occurring a lot faster than we would have also reasonably thought possible. If you look at what's transpired, and I'll focus the conversation on Australia for a moment, the monetary response that's come in so far, which included dropping rates, is more about making sure the plumbing in the system works. Flooding the system with liquidity, supporting the banks from a funding perspective, and making sure that some of the mistakes that were made in the early days of the GFC simply didn't occur. Dropping interest rates, as far as we can see, is of very little consequence to the economy directly. It's not going to stimulate credit demand, and the people that couldn't afford to service their mortgages at 3% probably can't afford to service them at 2.25%. The next thing we call out is the actions that we've seen our central bank take in Australia really could fit under the broad heading of quantitative easing. The rate signalling we've seen, the setting of the curve, was almost inconceivable just a few years ago in Australia. But what it has done, we believe, is set the foundations for ultra-low rates into the medium term. That's by virtue of the debt burden which Australia will now be carrying and the lack of inflation that's likely to be coming into the economy. As such, we can probably anticipate ultra-low rates can be hardwired for the medium term. Of course, it's difficult to make long-term predictions. What's been most startling, and it's probably given more confidence to financial markets and frank businesses more broadly, is the magnitude of the fiscal response the government has put forward. It's really hard to describe the package, which is, on any definition is north of 10% of GDP. It really makes what Wayne Swan and Kevin Rudd did a decade ago look like sprinkling a few pennies around. It was probably the single most important post-war piece of legislation that was hurried through in a matter of days with bipartisan support. But the programs that were put in place, I think, probably backstop this economy. It backstops the employment market, albeit there will be a spike in unemployment. But the JobKeeper program, to give everyone perspective and to put some life behind the numbers, to support 6 million employees for up to 6 months at a cost of $130 billion. That is, in effect, offering job supplements and subsidies to 65% of the private sector workforce, which is beyond anyone's wildest contemplation. Simultaneously, the government has tried to backstop the SME sector through tenancy laws being changed, tax relief, and bank support. They've also worked or lent, depending on how you think about it, on the banking sector to extend loans, to wave through the tidal wave of covenant breaches, which now seem likely, and to make sure there's continued access to credit through what a system could otherwise have been quite dysfunctional. So the government's actions, which were bold, large, you might argue imperfect, are a hell of a lot better than doing nothing. And in many respects, they've taken the worst case scenario off the table. What this will leave Australia with is the long-term consequences probably haven't been adequately thought through, but it's going to leave Australia obviously with an enormous tax burden, an enormous debt burden, albeit from a good starting point, that'll probably serve to be intergenerational. It has to be a drag on future growth, and it's going to be a long time before we hear politicians refer to back in the black in this context. The third thing I really want to call out is the next 6 months, notwithstanding the government support that's in place, corporate earnings are literally going to hit an air pocket. Earnings, in our opinion, will simply not be representative. There's a limited number of beneficiaries from the COVID-19 situation. Some are in healthcare, some are in groceries. We're seeing supermarket companies report 30 to 40% year-over-year sales growth versus a more normal 3 to 4% sales growth. We've seen all of the hoarding frenzies. We've seen a shift in the pull forward of demand, and we've seen households behave in a herding mentality like never before. So there will be a few companies that have benefited in an unsustainable way from COVID-19. Conversely, there's a lot of companies that have been adversely affected by what we're now referring to as hard stops. Policy-induced decisions that have been made to effectively curtail activity. It could be airports, could be shopping malls, could be casinos, and ironically, it also involves the hospitals, where most hospitals at this juncture are virtually empty, as almost all elective surgery has been banned or postponed. So what we're going to see from a second half fiscal 20 earnings perspective, to use a technical phrase, is carnage. We've seen countless companies withdraw guidance, and we don't think we'll see a set of numbers that are representative of the future, but they'll clearly be soft numbers, with many companies flipping from robust profits to abrupt losses in the space of weeks. What's a better representation from our perspective as we think about our investments in the future is to look at the second half of fiscal 21, or more importantly, fiscal 22, which will be a better read for how these businesses are responding in the new environment. Which raises the fourth point: how are companies going to go in responding through this well-documented valley that is being frequently discussed? And from our perspective and the research we do, it's all about balance sheets and it's all about liquidity. Now, the starting point in corporate Australia was significantly better than it was during the GFC. By way of example, the banks are holding approximately 3 times as much capital as they held prior to the GFC. Corporate leverage or corporate debt is lower, interest rates are lower, and most boards have been more conservative. So the starting point is significantly stronger. Having said that, the shock is significantly larger and harder to time. What we consequently believe is there'll be countless companies that will be breaching covenants. Companies that might have been in a robust position 3 months ago will now, in some respects, be at the mercy of banks, asking for leniency, And it's our expectation if the businesses were in good standing before, the covenants will be waived and the businesses will trade through uninterrupted, albeit the banks may get an uplift in margins or terms. So as we look at our companies, we're squarely focused on balance sheets, covenants, but importantly, liquidity. Companies need to make sure in this environment they've got access to enough funds to see their business through the tough patches that are invariably going to occur until activity normalizes. For many companies, the so-called valley could actually prove to be the valley of death. Many companies will collapse, unfortunately, and that's going to manifest itself in bank bad debts. Many companies will be forced to raise equity, and I'll comment on that in a moment's time. Or many companies will literally limp through like zombies with limited amounts of capital and limited capacity to grow. So in some respects, after a decade of good times, there's a degree of complacency around companies, credit terms, and balance sheets, and that's now manifesting itself as a significant weakness. The fifth point I want to raise is on equity raisings, which have been openly discussed in recent weeks. Our view is that there's an avalanche pending. To help frame the discussion, during the GFC, which was different but has some similarities, there were over 200 capital raisings in corporate Australia above $100 million. There were 50 companies that raised capital more than once. In total, it equated to 10% of the ASX 200, but that was heavily skewed towards banks and REITs that had multiple rounds of recapitalizations. The starting point for banks is stronger, and REITs we could see some, but not too many capital raisings occur. What we've observed over the last 2 weeks in this chapter has been probably less than a dozen capital raisings for less than $10 billion. So if you equate this to a GFC style episode, we are probably only 10 to 20% through the journey of capital raisings. Naturally, that is going to create some selling pressures on companies, and as investors, some awesome opportunities will arise, and we're actively anticipating which companies will raise and how we want to participate. From our perspective, we think our approach is clear, making sure all our portfolio companies have sufficient liquidity to get through the valley, to ensure that if they do need capital, we want to make sure that these are the types of businesses we want to support and will be on good standing on the other side of the valley, and make sure that they've got a reasonable margin of safety in the event that circumstances do drag on for some time. So as we start to think about some views or some predictions for the year ahead, our view is activity will rebound from the depressed levels we're currently observing. Having said that, they'll be rebounding into recessionary levels. Tim Toohey, who's our economist and strategy, is actively describing this as a V-shaped recovery, which I would probably agree with, but my views would be somewhat more tempered in that it may be a jagged V, and it will only be an incomplete recovery because we will not be rebounding to activity levels even close to what we observed in the past. Interest rates are likely to remain low, but this will leave a lasting legacy for the foreseeable future, in my opinion, on consumers and corporates, which will be more cautious, they'll curtail activity, which will lower the overall growth potential of the economy. Now, it's extremely dangerous to make any predictions around where COVID-19 will peak in Australia. What I would call out is if you look at the number of cases that are active, rather than the number of infections, if you look at active being infections less cures, we probably peaked a week or two ago in terms of the number of people that have actively got COVID-19 in Australia. Clearly, there's no room for complacency, but we need to alert to the fact that this economy will not be shut forever, and the 6-month timeline that many people are actually talking about could actually be sooner. And if that is the case, there'll be really significant investment opportunities that arise. As you look at the equities markets from here forward, there is a number of cross currents to call out. People are actively focused on the early access to super programs and the selling pressure that could create. We're also aware that dividend cuts are also pending for many companies, and the quantity of placements and equity raisings could also create downward pressure. So as you observe the market today, we're about 20 to 25% below where we were pre-COVID-19, depending on which hour you're looking at. But if you look on reasonable numbers for fiscal 21, fiscal 22, we've probably got 20% earnings downgrades to actually contend with. So from our perspective, we wouldn't call for a rally in equities, but what we would say is we expect to see a meaningful rotation inside the market as stability occurs and as people start to see signs that some of these programs will normalize. To put it in simple terms, at some point investors are going to focus on the fact that our airports won't always be empty and our shopping carts won't always be full. So before I hand it over to Ed to talk about infrastructure, I'll just spend a moment on the energy sector, which is where we're actively investing at this point in time. To frame the discussion, it's worth calling out that oil is always the most finely tuned and volatile commodity. It's a speculative commodity where there's probably 10 times more barrels traded than there is consumed. What we've seen in the oil market today is beyond belief or beyond any sort of historical recollection. The oil market can typically move on a 1% change in supply or demand. But in the last 3 months, we've probably seen demand fall by 25%, as aviation and road transport was curtailed. Simultaneously, we've seen supply expand by about 3% as OPEC Plus broke down. These facts were simply inconceivable 6 to 12 months ago. It's put the oil market in untenable territory at $25 a barrel, where probably half the world's production is losing money. We would expect capex to be curtailed, production to be slammed, and supply discipline to be pending. Demand will also recover as some of the restrictions start to relax. So our call is this isn't structural, this isn't cyclical, this is policy driven. And as such, we could expect to see an unwind over the next 2 to 3 years. And a similar thing occurred for different reasons coming out of the GFC. So we think there's a lot of money to be made by investing in a number of the energy companies like Origin and Santos at this point. So with that, I might hand it over to Ed to put a spotlight on infrastructure before we pause and take some questions. Thank you.
Okay, thanks, Dion. So as Dion previewed, I'd start by saying that our view presently is that the Australian infrastructure universe really does offer some compelling opportunities at the moment, and accordingly, it is the portfolio's largest sector overweight. Whilst some of the companies, and Dion mentioned Sydney Airport, have been heavily impacted by COVID-19, our view is that the virtues of infrastructure as an asset class do remain intact over the long term. Infrastructure is an asset class that is characterised by very long life assets that are very highly cash generative. These are essential assets with high barriers to entry and do have pricing power, which allows for inflation protection through the cycle. And typically, we would expect these assets to exhibit very stable levels of demand through an economic cycle. This time around, clearly, we're not seeing a traditional business cycle. Generally, in an economic downturn, we'd expect to see traffic on patronage assets such as airports and toll roads maybe move close to flat from previously low to mid-single digit levels of growth. But what we've seen here is what we would categorise as a hard stop event, and the defensive characteristics of the asset class in some instances has not been evident. So in the short term, we are seeing amplified effects on Australian infrastructure stocks. Sydney Airport has been the most impacted. Its revenue on a spot basis currently would be down 85 to 90%, and the company would be burning through cash of about $55 million per month. Toll roads, the second major asset class, has also been heavily impacted. What we've seen in economies which have gone into a sort of full shutdown, so this is the likes of France or Italy, maybe some parts of America as well. We're seeing traffic on toll roads down around 75%. In Australia, the shutdown measures aren't as severe, and we're seeing traffic on Australian toll roads, down around the sort of 40% range presently. An important thing to note, though, is even in sort of a severe shutdown scenario where traffic's down 75%, we still think these assets would operate around cash flow neutral. On the other hand, there are examples of Australian infrastructure stocks behaving quite defensively and uncorrelated. APA Group is a key example in the portfolio, which has seen minimal impacts on its cash flow and earnings. These COVID-19 impacts will be transitory, but what is important, and as Dion mentioned, that the companies do have the balance sheet and the liquidity to see themselves through the next 6 to 12 to 18 months. So from a liquidity perspective, and there's a slide in the deck that you've been provided with on slide 11, we would categorise all the Australian infrastructure stocks as being in quite a strong liquidity position, with plenty of cash available to cover near-term debt maturities, and in the case of Sydney Airport, cash burn as well. Something, a recent development that I think is also highly noteworthy is that we have seen both Transurban and Atlas Arteria's key asset APRR active in debt markets. So collectively, these two companies last week raised the equivalent of 2 billion Australian dollars from the European debt markets, bolstering their liquidity positions. So I guess, bringing this all together, given, our view that balance sheet pressures in the near to medium term are manageable, some of the moves we have seen in these companies have presented, really compelling investment opportunities. So Sydney Airport was a name that we've often owned in the portfolios. The stock's now down about, as of last night, was down about 36% year to date. At its low point, it was down about 45%. So as of last night's closing price, its market cap was down about $7 billion from where it was at the start of the year. To put this in context, it is likely that Sydney Airport might have operating cash losses of around $300 to $400 million over the course of the rest of the year if we remain at these shutdown levels. So when we put this in the context of an 80-year concession life, really sort of $300 to $400 million will have a negligible impact on something like a discounted cash flow valuation. Final point is just around the timing of recovery. Clearly, at this point, it's very difficult to call a recovery, and we are focused on medium-term earnings power and also the balance sheet strength. We do think assets such as toll roads will probably be somewhere around the forefront of a recovery in the economy. Obviously, we'll get people back to work. I think in the early stages, there'll also be a lower propensity of commuters to use public transport. And we also see toll roads as being a key beneficiary of government stimulus programs. And, that's both here in Australia, but also in some of the other geographies that the portfolio companies operate in, such as North America and Europe. Airports, on the other hand, are likely to see a more protracted recovery. And it could be 18 months to 2 years before we see traffic levels back at the level we saw in 2019. So just final comments is clearly, as you would have heard from Dion and I, we're attracted to the sector. We've been a material net buyer of infrastructure stocks over the last 3 or 4 weeks. And it's now one of the key overweights in the portfolio. With that, I'll hand back to Vito.
Thanks very much, Ed. Time for a number of questions, so we'll try and get through as many as we can. And thank you all for sending them through. It's been great. I might kick off with the first question. And the question is, how does Yarra Capital view the current position of the major banks to manage the capital and liquidity requirement, as well as the likely increase in loan defaults in the environment ahead?
So I might hand that one to Ed. In addition to being the infrastructure analyst, he's also got the great joy and luxury of being the banks analyst as well. So I might get you to kick off on that, Ed.
Thanks, Dion. So really great question. I think the question's really touched on gone to sort of the heart of a couple of the key issues for the sector at the moment. So by way of background, the portfolio broad cap strategies are broadly neutral banks at the moment. This cycle is different to the cycle we saw in 2007. Dion mentioned some of the indicators before, such as bank capital levels and corporate leverage as well. How we'd categorise it for the banks is this time around, it's very much more an earnings issue related to bad debts than it is a balance sheet issues related to the amount of capital. So seeing ample capital to be able to handle whatever the cycle throws at them. So, to that extent, we're not anticipating a round of bank capital raisings. Bad debts is the big open question. To sort of to get our sort of arms around this issue, we've run a number of scenarios and continue to run a number of scenarios. A base case scenario would have bank earnings down about 20% year over year, with bad debts on business loans, rising to 100 basis points. For context, in the global financial crisis, they probably got to around 80 basis points. In that scenario, the banks are still, very profitable. As I said, earnings only down 20%, and still would be accumulating capital. Our bear case scenario, where we sort of go to peak losses, so sort of think 1993 type losses on business lending, you'd have housing loan losses around 10 basis points, which is a level really we haven't seen on a system level before in Australia. The banks would still remain profitable at that level, although clearly it's not going to be a lot of fun for them. The capital position would remain relatively protected. So there are a couple of considerations we have at the moment. Sort of the third one I'd throw in is valuation. So as it tends to do, the market moves pretty quickly to price this in for the banks. They're trading below book value, or three of the majors are trading below book value for pretty much the first time in history. So it's weighing up, what is a very difficult fundamental outlook over the next sort of 2 years, with what's also very low historic valuations.
Right, thanks, Ed. Next question is around infrastructure, and the question is: would infrastructure companies need to do capital raising if a partial lockdown is maintained for the next 12 months?
Okay, so I might run with this again, Dion.
Yep.
So again, a really good question. So the key issue here, I didn't touch on it in my prepared remarks before, is around covenants. And so the nature of covenants, it's case by case. So there's a broad generalisation. If we remain in, most of the companies are fine at the moment. Covenants are typically for infrastructure companies tested on a rolling 12-month basis and tested every 6 months reporting season. So even sort of in the sort of shutdown scenario persists, we're not going to run into covenant issues until sort of the fourth quarter of this calendar year, that they're going to start butting up against the covenants. For probably, Sydney Airport, as we mentioned, has seen the most revenue pressure. To give you sort of context for what's the scenario where they avoid covenant pressures, their covenants are actually, reasonably favourable to them. It's a 1.1 times interest coverage ratio. So EBITDA to interest costs of 1.1 times. If they were to see, if we were to have sort of 6 months of shutdown and then a very gradual recovery in domestic activity and traffic levels in the fourth quarter, they would avoid covenant pressures. So it does take quite a dramatic downturn to see them run into covenant issues. And then the final point is just around sort of the maturity of the financiers in the conversations they're having. So again, that's case by case, but it is definitely a live consideration.
Okay, maybe time for a couple more. There's a number around banks. I'll try and merge a couple of questions into one. I guess the question is your outlook for banks, given the backdrop of potential limited growth outlook and likely deferred dividends.
Yes, I might just add a few comments there. As we think about banks versus the rest of the market, what we'd say is there is value, but there is headwinds, and there's a lot of operating momentum against the businesses, which is why we've got a reasonably flat position vis-a-vis benchmark. Still some very active bank calls inside of the positioning we actually have. Dividend deferrals is an interesting topic. APRA came out with some guidance this week, which was deliberately very vague, which is to say you can pay dividends. We'd prefer if you didn't, and if you did, don't pay big ones. So my view is the banks will be cautious. The banks are going to accumulate capital in this environment, but I still think dividends are conceivable later on this calendar year. So from our perspective, not getting dividends is clearly a bit of a setback, but if the value is being accumulated, it still sits inside the company, as do the franking credits. When the environment improves, you'd expect to see that returned. As Ed said, even under our stressed scenario for Australian banks, they are still profitable. They're still actually neutral to possibly gaining capital and would still be able to pay dividends, albeit not that significant. What we call out here is banks versus other parts of the market probably look a bit less attractive given the headwinds that we've described already. So from our perspective, what looks interesting to us is infrastructure. What looks interesting to us is some of the energy companies, a number of the industrial companies as well, where activity has currently been curtailed, but we can see it snapping back relatively quickly.
Great, thanks, Dion. Given that we've just ticked over 3:30, we might make this the last question, and then I'll wrap up quickly. The final question: what are your base and worst cases for the unemployment rate in Australia?
Yeah, so Tim Tui is probably a much better place to answer this question than I have. Let's use the starting point, and it was about mid 5.5%. People who are on job seeker shouldn't actually be filing for unemployment or participating in the surveys lodging the fact that they're actually unemployed, because they will have continuing employment. So the fact that job seeker, if the Australian workforce is circa 13 odd million people, the fact that job seeker covers close to half the workforce will mean the unemployment rate that we might have thought was possible a month ago is highly, highly unlikely. So I think the way that Tim would describe it is the starting point is an unemployment rate starting with a 5. I think he said he could see it touching 10 relatively quickly, and expect it to trend down to probably a number between 7 and 9% as activity starts to normalise and some of the curtailment measures are actually relaxed. So it is a big step up in unemployment. It'd be an order of magnitude larger if the JobKeeper program wasn't in place. But to give everyone a bit of perspective, during the GFC, the unemployment rate went up by 200 basis points from trough to peak. We'd expect this to be a bigger increase.
Great. Thank you, Dion. Thank you, Ed. And a big thank you to everyone for your attendance today, your participation, and importantly, your ongoing support. We really do appreciate the fact that it's busy times, it's on uncharted waters, and giving up part of your day to listen to us is greatly appreciated. Following today, if you've got any other questions, by all means, please reach out to myself or Nick Green in the first instance, and we're happy to answer where we can. If not, happy to arrange a discussion with the various team members. I might ask you just to keep an eye out for another session we're running next week at the same time, featuring Tim Tui, our Head of Macro and Strategy, and Katie Hudson, our Head of Australian Equities Research and the Portfolio Manager for the Small Companies Fund. Once you leave today, you'll receive a survey. Any feedback greatly appreciated. Always looking to improve these sessions and provide greater insight. So any feedback you could give would be greatly appreciated. And finally, on behalf of Yarra Capital Management, a big thank you for joining us this afternoon. Have a great day. Have a safe Easter period and long weekend, and we look forward to hearing from you soon. Take care. Bye-bye.
Thank you.